$25. It doesn't really sound like much, does it? It's the price of a couple of dinners, a night out, or maybe some snacks and coffee. It's easy to think, what's $25 really going to do for me? So we spend it without much thought, and before we know it, it's gone. The truth is, most of us don't think twice about $25 slipping through our fingers. But what if that same $25 invested each week could eventually make you more money than a full-time job? In this video, I'll show you how a small $25 weekly investment can grow into something much bigger than you expect. We'll talk about how inflation slowly eats away at your paycheck, making it harder to get ahead. Then, we'll see how compounding works to make your money grow, even when the market is up and down. I'll also show you how to build a Fidelity Index Funds portfolio for this strategy. By the end of this video, I'll show you how the same Fidelity portfolio could turn your $25 a week into a portfolio worth over $600K, paying over $4,800 in monthly dividend income. But before we get into the details, let's understand why weekly investing really works in the real world. A lot of people hesitate to invest weekly because $25 doesn't seem like it could make much of a difference. And it's true, in the short term, $25 might not feel like it's going to change everything. But that hesitation usually has less to do with investing and more to do with pressure. You can see this pressure clearly when you look at inflation over time. Inflation has been around in the US economy for ages. While it goes up and down, it never fully disappears. Even in 2025, with inflation sitting around 2.7%, prices are still climbing every year. That means money loses purchasing power even when things feel stable. What makes inflation feel heavier is where it shows up. Essential categories rise faster than optional spending. Transportation costs have been increasing around 5%, housing costs roughly 4%, and food and beverages near 4% as well. Medical care continues to trend higher. These aren't upgrades or lifestyle choices, they're basic expenses. That's why inflation isn't abstract. You feel it at the gas pump, at the store, and when monthly bills come due. Because of this, people change the way they spend. Around 62% of Americans say inflation impacts how they save and spend. Only 19% say it hasn't affected their habits. It's not just about prices rising, it's about making people second-guess how they spend their money because their budgets are tighter. At the same time, borrowing money has become more expensive. After years near 0%, the federal funds rate now sits at 3.72%. That makes loans, mortgages, and credit cards more expensive. Even those who avoid debt still feel the impact because higher rates affect everything: rent, services, even everyday prices. Meanwhile, wages are growing but not enough to keep up. Average hourly earnings are going up around 3.5 to 4% a year. While that helps in the short term, it doesn't really make a big dent in the long run. So even though we're working harder, it doesn't always feel like we're getting ahead. Your paycheck may grow, but your purchasing power barely moves. Then there's the stock market. Over the past 100 years, markets have survived wars, depressions, crashes, pandemics, and inflation shocks. Sure, every downturn feels scary in the moment, but the overall trend has always been upward, with average returns around 12%. The beauty of weekly investing is that it doesn't rely on predicting those ups and downs. If the market goes up, you invest. If it drops, your investment buys a higher number of shares because the prices are down. When it rebounds, you're right there, benefiting from the growth. When paychecks grow nearly 4% a year, but long-term portfolios grow 2 to 3 times faster, consistency starts building towards something income alone can't. Once you see how this works, it's easy to understand how even small weekly amounts can eventually turn into a much bigger snowball than most people expect. The snowball effect becomes easier to see when you look at how small weekly investing behaves in the early years. Let's break it down and see how it plays out over the first few years. Imagine you start by investing just $10 every week. In 1 year, that adds up to $520. Even though this doesn't seem like much, the magic happens when your money starts to grow. In year 1, you invest $520. With a 10% return, that $520 grows by $52, bringing your total at the end of the year to $572. In year 2, you add another $520 to your investment, bringing the total contributions to $1,040. Now your balance from year 1, $572, is combined with the new $520, giving you $1,092. Applying the 10% return to the total balance of $1,092 adds $109, bringing the total at the end of year 2 to $1,201. In year 3, you add another $520, making your total contributions to $1,560. Now your balance from year 2, $1,201, is combined with the new $520, giving you $1,721. Applying the 10% return to this new total adds $172, bringing your total at the end of year 3 to $1,893. Each year, as the money continues to grow and earn more on top of what you've already invested, the snowball effect picks up speed. Your weekly $10 investment is now growing faster than it did at the beginning. The first few years don't look exciting, but they build the structure that makes long-term growth possible. Later, you'll see how the same snowball effect can turn a $25 weekly habit into a $600,000 portfolio that pays over $4,800 a month in dividends. Understanding how that snowball forms is only half the story. The other half is how we think about investing and how to stay committed even when the results aren't immediately visible. Most people don't give up on weekly investing because the math doesn't work. They give up because the early results feel discouraging. You put in your $10, $25, or $35, and the balance barely moves. Your brain expects to see progress, and when that doesn't happen, doubt creeps in. But this doubt has nothing to do with the returns. It's all in our heads. We're wired to think linearly. If we put in more effort, we expect more reward. If we work more hours, we expect a bigger paycheck. But investing doesn't work that way. In the beginning, you can see the effort, but the results aren't visible right away. The payoff is delayed, and it's tough to stay motivated when you don't see immediate rewards. Market noise and fluctuations make this harder. A down week feels like failure. A scary headline feels like a warning sign. When you're just starting, volatility feels personal because your balance is small and easy to track. But these reactions come from focusing on short-term movement instead of long-term behavior. The real shift happens when you change the way you measure success. Instead of asking how much did my portfolio grow this week, ask yourself, did I invest this week? This simple change removes the emotional ups and downs from the process and puts the control back in your hands. This mindset allows investments to outgrow income. Once you get the habit of investing down, the next question becomes, what do you invest in? This is where a lot of people tend to overthink things. They start searching for the perfect stock or trying to time the market. But long-term investing is actually a lot simpler than that. It's about investing on a few key qualities that matter, no matter what's happening in the market. First up is diversification. If you only own one stock, one bad report could seriously hurt your plan. But when you own hundreds or thousands of companies, the risk gets spread out. If one company struggles, others will keep growing. Broad index funds are designed to do this automatically, without you needing to make constant decisions about each individual stock. Next is exposure across different parts of the market. Markets aren't static, they change. Some years big companies lead. Other years smaller or international companies might outperform. A well-built portfolio doesn't try to guess which will win in any given year. Instead, it holds a mix of different companies, industries, and even countries. This way, growth continues no matter which segment is in the lead. Dividend growth is another important factor. A high dividend today is nice, but it's more valuable if it keeps growing over time. Companies that consistently raise their dividends create a cycle of growth. Those growing dividends buy more shares, and those new shares generate even more dividends, helping your money grow on its own. Consistency in historical performance is also key. This doesn't mean chasing the hottest stock of the year. It means looking for companies or funds that have survived multiple market cycles through booms, crashes, recessions, and recoveries. Longevity shows resilience. You want investments that can handle whatever the market throws at them. Finally, low costs protect compounding. Even a 1% fee reduces long-term results more than most people realize. Funds with minimal or zero expense ratios keep more of your money working for you year after year. When you put all of this together, diversification, broad exposure, dividend growth, proven performance, and low fees, you end up with investments that are built to survive uncertainty and grow steadily over time. And that's exactly what the Fidelity funds in this portfolio are built to do. Now that we've got the strategy in place, let's see how these funds work together to make it all happen. The power of this strategy doesn't come from any one fund doing something extraordinary. It's about how these solid funds work together, each playing its part and supporting the same long-term growth engine. At the heart of the portfolio is the Fidelity Zero Total Market Index Fund, FZROX. This fund gives you exposure to the entire US stock market all in one place. It includes large, mid-sized, and small companies across every major industry. It's like getting a little piece of the entire market. It has a dividend yield of 1.01%, a solid 7.19% growth rate for dividends over the last 5 years, and an annual share price increase of around 14.06%. This fund acts as the core driver of growth in the portfolio. Next, we have the Fidelity US Sustainability Index Fund, FITLX. This fund focuses on companies with strong environmental, social, and governance standards. These are the companies that not only do good in the world, but are also increasingly profitable and forward-thinking. This fund currently has a yield of 1.1%, a 15.42% dividend growth rate, and a solid annual appreciation of 13.92%. It adds a modern growth angle to the portfolio without sacrificing diversification. Then there's the Fidelity Growth and Income Portfolio, FGRIX. This fund balances things out by providing steady income while still focusing on growth. It invests in high-quality companies that generate consistent cash flow and grow steadily over time. With a dividend yield of 1.04%, an impressive 27.47% dividend growth rate, and 10.46% annual price appreciation, it strengthens both income and growth in the portfolio at the same time. Following that, we have the Fidelity Dividend Growth Fund, FDGFX. This one focuses on companies with a long track record of consistently raising their dividends. Its role is to bring stability to the portfolio. It currently yields 1.24%, has a 22.81% average dividend growth rate, and while its price appreciation is more modest at 5.08%, it helps smooth out the ups and downs of the market, strengthening your income, especially during slower market periods. Finally, the Fidelity Global ex-US Index Fund FSGGX adds international exposure to the mix. This helps reduce reliance on just the US market and captures growth from outside the country. It offers the highest yield in the portfolio at 2.52%, with a solid dividend growth rate of 15.15% and annual price appreciation of around 7.62%. The next step is to calculate the portfolio's metrics, starting with the dividend yield. Since we're keeping it simple, we'll use a simple average. First, we list out the dividend yields of each of the 5 funds. FZROX has a yield of 1.01%. FITLX is at 1.1%. FGRIX is at 1.04%. FDGFX offers 1.24%, and FSGGX has a yield of 2.52%. Next, we add those together. 1.01 plus 1.1 plus 1.04 plus 1.24 plus 2.52 gives us a total of 6.91. Since each fund makes up an equal portion of the portfolio, we'll divide that total by 5, which is the number of funds. So, 6.91 divided by 5 gives us an average dividend yield of 1.38%. That's how we calculate the overall yield for the portfolio. You can use the same process for the portfolio's dividend growth rate and its annual price appreciation. Just add up each fund's growth rate or price change, divide by 5, and you'll get the average for the entire portfolio. For this portfolio, that calculation shows an average dividend growth rate of 17.61% and annual share price appreciation of 10.23%. Growth pushes the value of the portfolio higher, rising dividends boost your income, and diversification ensures everything keeps running smoothly through all sorts of market conditions. Let's take a look at what happens when you invest $25 a week into this portfolio, $5 in each index fund every week. By the end of year 1, you'll have invested $1,300 into the portfolio. This amount sets the foundation for future growth. Looking ahead to year 10, projections show the portfolio will grow to about $23,000, with annual dividend income reaching around $500. By year 20, the portfolio is projected to climb to approximately $113,000, with annual dividend income rising to nearly $5,000. The final decade is where the curve steepens. By year 30, the portfolio is expected to reach about $641,000, with dividend income expanding to roughly $58,000 a year, or around $4,800 per month. At this point, the growth in income will accelerate faster than your weekly contributions. The portfolio's growth is no longer dependent on what you're adding. It's being driven by the growth that has already been built. Want to know how to turn the same $25 a week into a $1.6 million portfolio that pays over $6,000 in dividends every month? Click the video on screen to find out how.